Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having long-term care benefits in place can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, JenniferLangFinancialServices.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, JenniferLangFinancialServices.com. The chat is open, so tell me your name and where you're from, and I'll get to questions as time allows. I see some names in the chat box already. Hi, Matt from Arkansas. Good to see you. Gregory from Virginia. Good to see you too. I see Nancy from Georgia. Glad you made it. Well, thank all of you for joining. Today's webinar is entitled 5 Smart Investing Principles. And as Mike mentioned, a person can either learn things the easy way or they can learn things the hard way. And in my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that it was such a powerful wealth accumulation and protection vehicle. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. So let's jump in. There is no shortage of self-help material available for people looking to boost their knowledge. Between television programs, magazines, and other information sources, you can read about the best this and the most important that. It can be easy to get confused, especially when you get conflicting ideas. Understanding a few key investment principles can be a great place to start. It can give you a better framework to understand the information as you take in the ideas. It could also provide context for evaluating the concepts and strategies suggested. This presentation goes through 5 smart investing principles. These are key concepts that could help you understand what it takes to create an investment portfolio that's designed to pursue your investment goals. At JenniferLangFinancialServices.com, we provide a wide range of services with the primary commitment of helping our clients pursue their unique financial objectives. We want to help you develop an overall strategy tailored to your goals and time horizons. JenniferLangFinancialServices.com is dedicated to helping individuals evaluate their financial situations. We want to provide people with tools that can help them make informed decisions. We offer informational material on a wide range of topics because we understand that individuals have diverse financial needs. If you have any questions or concerns during the course of this presentation, we invite you to take advantage of our complimentary consultation. During the consultation, we can discuss your questions and begin the process of helping you develop a financial approach that will address your financial and individual needs. Keep in mind that the information in this material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. Please consult a professional for specific information regarding your individual situation. There are 5 smart investing principles that are helpful to understand if you want to potentially break the cycle of buying high and selling low. Are there other investing principles? Well, absolutely. But for the purposes of our discussion today, we're going to focus on the 5 that we believe are critical to understand. First, estimate your time horizon. Is your investment horizon 3 years away or 30 years away? Second, know your risk profile. Can you tolerate big swings in the value of your investments, or do you prefer less volatility? Knowing your risk profile is an important step as you consider various types of investments. Third, diversify, diversify, diversify. This one's so important we listed it 3 times. Fourth, consider the effects of taxes and inflation. And finally, get started now. Take the initiative and get going. If you learn nothing else today, please understand the importance of getting started now. When it comes to pursuing investment goals, the more time you have, the better. The following video looks at how time affects the accumulation phase of retirement.
When investing for retirement and other long-term goals, you want to put time on your side. The sooner you begin investing, the longer your money can work for you. But it's easy to procrastinate. Let's take a look at what procrastination can cost you. Sally and Bob each decide to invest $250,000 into a retirement account. When Sally turns 50, she starts contributing $25,000 a year to an account that earns a hypothetical 6%. After 10 years, she stops making annual payments. Bob, on the other hand, puts off his investing program. Finally, at age 60, he begins setting aside $25,000 a year into an account that earns a hypothetical 6%. Though both have contributed equal amounts, Sally has the magic of compound interest working for her. When they both reach age 70, Sally's account balance is nearly twice the size of Bob's. Procrastination can be costly, and as Bob learned, when you get a late start, it can be difficult to make up for lost time. Call today and let's get started now.
Let's take a look at our first principle, estimating your time horizon. Generally, if your time horizon is short, you may be more comfortable with a more conservative investing approach. Certain investments can be volatile and may not be appropriate if you have a short-term horizon. If your child is headed to college in 5 years, many people would say you have a midterm horizon. You may want to be less conservative with your investing approach and have a larger exposure to equity investments. When you have a long-term horizon, you may consider adopting a more aggressive approach. If you intend to retire in 10 to 15 years, having a larger exposure to stock investments may make more sense. One way to lower your exposure to stock market risk is by investing for the long term, which gives your money time to recover from periods of market fluctuations and loss. Of course, past performance is no guarantee of future results. Let's move from estimating your time frame to our next principle. Know your risk profile. How much tolerance do you have for risk? It's easy to say, oh, I can handle a high level of risk. But that may or may not be the case. It's a good idea to ask yourself some pointed questions and be honest with the answers. What happens to my outlook if the value of my investment drops? How much could I lose and stay in the market? It's also helpful to ask yourself, how would I describe my investment knowledge? There are some television programs that help people understand investments and how markets work. But if most of your investment knowledge has come from television personalities, You may want to consider getting a second opinion on your approach. Here's another helpful series of questions to ask yourself. What would you rather have? $500 right now or a 50% chance at $2,000? Many people would go for the $2,000, and rightfully so. Since you have a 50-50 chance, a decision tree shows the $2,000 answer carries a potential value of $1,000. But let's add a few zeros and see if that changes your perspective. What would you rather have? $50,000 right now or a 50% chance at $200,000? The decision tree says the opportunity to win $200,000 has the highest potential value. But in reality, many people second guess that decision because $50,000 is a lot of money. Remember, there is no correct answer to the questions. They simply help you better understand the concept of risk. Investment risk can be managed, but it can't be eliminated entirely. All investments carry some level of risk, and in general, the greater the risk an investment carries, the higher its potential return. This illustration may help you understand how this works. Along the horizontal axis is risk. The lowest level is on the left and the highest is on the right. Along the vertical axis is potential return. The lowest is at the bottom and the highest is on the top. Different types of investments fall into different places on this graph. Keep in mind, however, that past performance does not guarantee future results. Actual results will vary. With the lowest risk and the lowest potential return are cash alternatives such as certificates of deposits, which are generally considered to be relatively safe investments. Now, if you sell before a CD reaches maturity, you may be subject to penalties. Bank savings accounts and CDs are FDIC insured up to $250,000 per depositor, per institution, and generally provide a fixed rate of return. Traditional CDs offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Further up on the graph are debt instruments, such as government bonds, debt instruments. These offer slightly higher return, but at slightly higher risk. It's important to remember that bond prices, including on government bonds, rise and fall daily. If a bond is held to maturity, a bondholder will receive the interest payments due plus original principal, barring default by the issuer. Return of principal is not guaranteed. Next are stock investments, which offer the potential for higher return, but they also have a higher risk. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. At the top are speculative tools. Speculative tools are not appropriate for every investor. They carry a high level of risk and when sold may have little or no value. Consider working with an investment professional to better assess the risks associated with a speculative tool. Risk can come from different sources. For example, there are external risks that may influence the price of a stock. That is, sources of risk that are outside a company's influence. These may include economic, market, interest rate, political, and even tax risk. Let's take a closer look at one of those risks, market risk. If the overall stock market trends lower, many stock prices would be expected to trend lower as well. Conversely, if the market trends higher, many stocks prices may move higher. It's like the old expression, a rising tide lifts all boats. On the other side of the scale are company-specific risks. These are risks that are unique to the company, such as a delayed product launch, unexpected expenses, supplier problems, and a management shakeup. By buying stock in an individual company, you are agreeing to accept a certain amount of company-specific risk. The next investment principle is diversification. Diversification suggests that a portfolio of different kinds of investments, on average, may potentially yield a higher return and pose less risk than any individual investment. In short, diversification helps manage the company-specific risks we illustrated on the previous slide. Let's assume we have an investor who has $750,000 to invest. On the left is a hypothetical example of $750,000 placed into a single investment. On the right is a hypothetical example of the same amount divided between 3 investments. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. Now, this is a hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. Now, after 20 years, the single investment, assuming a 5% annual return, will have grown to roughly $2 million. During the same period, our diversified portfolio will have grown to just over $2 million. And in this example, we're assuming that one of the investments was a total loss. That is, it was worth nothing at the end of 20 years. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. This is a hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. So there's more to diversification than simply spreading your money around to different investments. In principle, you want to select investments that have a low correlation with each other. That is, investments that don't tend to behave the same in a market environment. One measure of correlation is called the beta, B-E-T-A. Beta is a measure of a stock's correlation with the overall stock market. Beta is a measure of how likely a stock is to move up and down as the overall stock market moves up and down. In this example, we're using the Standard & Poor's 500 Composite Index, total return, to represent the market. So it has a beta of 1. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Individuals cannot invest directly in an index. A stock price that varies more widely than the S&P 500 would be expected to have a beta that is greater than 1. A stock with a beta of 2, for example, will rise and fall on average by twice as much as the wider stock market. So, if the S&P 500 falls by a hypothetical 1%, a stock with a beta of 2 would be expected to drop by 2%. Make sense? Beta can also be negative. For example, a stock with a beta of -1 would expect to see its value fall by 1% when the market rises by 1%. What we have reviewed are hypothetical examples used for illustrative purposes only, okay? They are not representative of any specific investment, and past performance does not guarantee future results. Another investing principle is the consideration of taxes and inflation. This chart shows how many days the average American will work in 2018 to pay their tax obligation. Americans pay income taxes, Social Security taxes, sales and excise taxes, and property taxes. The same concept occurs when you put your money to work. Taxes may take part of your return. So, when you are looking at the return on an investment, ask yourself, what is my return after taxes? Another silent thief you have to watch out for is the effect of rising prices, otherwise known as inflation. Over the long term, inflation erodes the purchasing power of your income and wealth. It's easy to see. Just look at prices from 1967. In 1967, a new house cost $14,250. Income was $7,300 per year. A gallon of gas cost 33 cents. And the average cost of a new car was $2,750. In 2017, the average price of a new home was $402,900. The median household income was $61,372 per year. The average price for a gallon of gas was $2.42. And the average price of a new car was $36,113. The following video puts all of this together.
$1 million. Sounds like a lot, doesn't it? Well, it is. $1 million $1 bills, stacked one on top of the other, would reach 358 feet, or the height of a 35-story building. It's a lot of money. These days, however, $1 million doesn't buy what it used to. In 1906, the luxury steamliner Hendrick Hudson was built for $1 million, as was the largest private residence in Chicago, the Palmer Mansion, which finished construction in 1885. So what can $1 million buy you now? Well, you couldn't build a steamliner, but you could buy a used yacht. It might not buy you a mansion in Chicago, but you could get a small one-bedroom, one-bathroom apartment in New York City. Or $1 million in a diversified portfolio could help finance part of your retirement, offering both growth and income. Let's see how this works. Say a couple retired at 65 with a $1 million investment portfolio. During their retirement years from age 65 to 90, the money could generate a $45,000 annual income, increasing at 3% a year, assuming a hypothetical 5% annual rate of return. At age 90, the portfolio would have an ending balance of nearly $500,000. What's more, the portfolio would have generated $1.6 million in total income. Call today and schedule your review.
Our last investment principle is just get started now. Procrastination can be costly. For example, if you were to deposit $250,000 in an account earning 6%, at the end of 20 years, your account would be worth $801,784. If you waited 5 years before starting your investment program, the $250,000 would have only 15 years to work. It would grow to $599,140. And if you waited 10 years, then started your program, you'd only end up with $447,712. Put another way, waiting 10 years to start was a $350,000 decision. Keep in mind, this is a hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. When you're ready to move forward, we've identified some specific action items to help you get started. First, put together a personal income statement. You want to identify all your sources of income and where your money is going. Next, put together a simple balance sheet. This should give you a good snapshot of your assets and liabilities. Identify your long-term, medium-term, and short-term financial goals. Then, be honest with yourself about your tolerance for risk. Can you stomach big market swings, or are you more comfortable with less volatility? Once you have sized up your personal finances, you may be ready to discuss your situation with a professional. Following a few smart investment principles can make your investment efforts much more effective. But it doesn't end there. Effective investing requires an ongoing effort, and there's a lot more to know. Here are some questions that arise at different stages of life. Anthony and Selena have a growing family and wonder, what's the best way to fund our children's college education? Dave and Christine are in retirement, and they ask, should we change the allocation of our portfolio now that we're no longer working? Rebecca is a single woman with a small business, and she wants to know, my business is finally doing well. What's the best way to put my extra income to work for my family's future? And Isaac likes to do research online. He asks, does it make sense to watch the market every day and trade on what happens there? Well, answers will depend on each unique situation. And that's where we come in. At JenniferLangFinancialServices.com, we specialize in helping people just like you put together strategies to pursue their specific objectives. Take advantage of our offer and schedule a complimentary consultation today. Well, thank everyone for attending. Until next time. Fewer and fewer employers are offering pensions these days. If you own a business, chances are you're caught between a rock and a hard place. You want to keep operating costs low, but you also want to help your employees. At JenniferLangFinancialServices.com, we've got you covered. With life insurance-backed options that can provide more benefits than a traditional 401k, we will work with you to find the best plan to fit your retirement needs. Visit us online at JenniferLangFinancialServices.com. Protect your retirement from potential market downturns and risk. We offer annuities, 401k rollovers, and no market risk retirement planning. Visit us today, JenniferLangFinancialServices.com.